Imagine you're walking down the Wall Street, watching big investors pour millions into stocks, hunting for the next big win. But what if I told you there's a simple formula, one that could turn regular people, not just Wall Street elites, into successful investors? That's exactly what Joel Greenblatt, a renowned investor, professor, and founder of Gotham Capital, discovered. Greenblatt isn't just any investor, he's one of the best. Over a decade, he achieved an astonishing 40% annual return at Gotham Capital from 1985 to 2005. This remarkable track record helped solidify his reputation as one of the most successful investors and highlighted the effectiveness of his investing principles, turning his fund into one of the top performing hedge funds of all time. And the strategy behind his success? It's shockingly simple, a method he calls the magic formula, which anyone can use to pick stocks that beat the market. This isn't just another investing book filled with theories. It's a guide that reveals a straightforward, data backed formula designed to help anyone, whether you're a beginner or an experienced investor, choose winning stocks. And no, you don't need a fancy degree or years of experience to get it. This is the Better Investor, helping you achieve your financial goals and freedom by summarizing books for you about stock market investing, finance, and learning from successful people in this field. And these are top 5 lessons from the book Little Book That Beats the Market, written by Joel Greenblatt. Lesson number 1. Mr. Market is crazy. Joel Greenblatt was an adjunct professor at the Columbia University for 9 years before he got his hands to pen writing this book. In his class, he would ask the students to go to the newspaper and find the name of a big well-run company. Let's do this exercise now. Let's say that the company is Apple, the product of which is used by almost everyone. Now the next question he would ask, what's the 52-week high and low price of the stock? Within 1 year, people were willing to pay as low as $160 for this stock and as high as almost $240 for it. That is a difference of more than 50% from the lowest price in this year. If not Apple, let's say some boring business. Let's take a paper manufacturer in India, which is JK Paper. Its price range goes from as low as 320 Indian rupees to as high as 630 Indian rupees. That's the difference of more than 90%. That's a pretty wide range of prices for shares in a pretty short period of time for them to change so much. How can this be? So why do share price move around so much every year when it seems clear that the values of underlying businesses do not? Well, here's how Greenblatt explains it to his students. Who knows and who cares? He says the truth is that we don't really have to know why people are willing to buy and sell shares of most companies at wildly different prices over very short periods of time. We just have to know that they do. Why is this helpful? Let's think about that. If you're confident about understanding the value of company and you estimate it somewhere between $12 to $15 a share, and suppose during the varying time of the year, shares could be purchased at $6 and $11. Well, if you were confident about your estimate and what the business was worth, then deciding whether to buy the shares when they were trading near $11 might be a difficult decision. But when shares in that same company during that same year were available at close to $6, your decision might well become much easier. At $6 per share, if your estimates of value were close to correct, then you would be buying shares in the company for only 50 to 60 cents on the dollar. Graham referred to this practice of buying shares of a company only when they trade at a large discount to true value as investing with a margin of safety. Written in the book The Intelligent Investor by Benjamin Graham, the father of value investing. In short, you are never required to act. You alone can choose to act only when the price offered by Mr. Markets appear very low, that is, when you might decide to buy some shares, or extremely high, That is when you might consider selling any shares you owe to the market. Lesson number 2. The magic formula. What is the magic formula? It's a simple two-step recipe for picking stocks with high potential. Greenblatt created this formula based on decades of research and found that it consistently beat the market over time. So what does the magic formula do? It focuses on identifying companies that are both good and cheap. Good here means the company has a solid ability to make profits, and cheap means the stock is trading at a price that's a bargain compared to the company's actual worth. In short, the magic formula tells us to invest in companies that are high quality but currently undervalued by the market. By buying these companies, we are positioning ourselves to benefit as their prices eventually rise to match their true value. To break it down, magic formula looks at two main factors to determine if a company is a good investment. That is return on capital and earnings yield. Firstly, return on capital. This is a way to measure how well a company generates profit from its resources. If a company has a high return on capital, it means it's making a good amount of money from every dollar it invests in its operations. Imagine, you start a small business selling lemonade. You spend $100 on lemons, sugar and cups and you make $200 in sales. Your profit is $100, which means you made 100% return on your initial investment. If you see a company with high returns on capital, it's like a lemonade stand that consistently doubles its money. The magic formula prefers companies with a high return on capital because it shows that they're efficient and profitable. Second, the earnings yield. This measures how cheap a company's stock price is compared to its earnings. It's a bit like asking how much bang you're getting for your buck. Let's say you want to buy a new phone. You find two models, one for $300 and another for $500, but both have the similar features. The $300 phone gives you more value for your money, just like a stock with a high earnings yield give you more earnings for your investment. The magic formula looks for stocks with high earnings yield, as these stocks may be underpriced by the market, creating a good buying opportunity. So let's see how the magic formula works. First step is to screen for the companies. First, you make list of the companies with positive earnings which are not in industries like finance or utilities. Greenblatt excludes these because their earnings and capital needs are harder to measure in a simple way. Then in second step, he asks us to rank them by return on capital. Ranking these companies based on return on capital from highest to lowest. After this, the top companies here are the good ones, those making most money from their investment. Then rank the same companies by earning yield from highest to lowest. Top companies here are the cheap ones, meaning you're getting the most earnings for your investment. For each company, add up its rank from both lists. The companies with the lowest combined rank are considered the best magic formula stocks. These are the companies that are both good and cheap. Finally, pick the top 20 to 30 companies from the list. Greenblatt suggests holding each stock for 1 year, then rebalancing, which means replacing companies that no longer rank as well with new top ranked ones. The magic formula works because it's based on logic. Companies with high returns on capital and high earnings yield are often overlooked gems. Lesson number 3. Patience is the key. This approach isn't a fast track to getting rich. It's about building wealth steadily over time. Joel Greenblatt, the creator of the magic formula, emphasizes that there will be ups and downs. It's completely normal for the strategy to have years when it doesn't outperform the market or even underperforms. But the key here is consistency. If you stick with it over the long term, the formula's result starts to compound. And this patience can ultimately lead to strong market-beating returns. In a sense, think of magic formula like planting a tree. At first, it might not grow much, but if you care for it, give it time and resist the urge to dig it up, it'll eventually grow tall and strong. producing fruits over time. Likewise, with investing, the reward is often for those who don't panic and don't get impatient. To illustrate, Greenblatt shares a real world example in his book. He created a portfolio based on the magic formula and tracked it over multiple years. In some years, it performed well, but in others, it didn't look so impressive. In fact, there was a period when his magic formula portfolio underperformed the broader market for 2 years in a row. Many investors would have felt frustrated and might have been tempted to abandon the strategy. But here's what happened in the long term. Over a 17-year span, the magic formula delivered an average annual return of more than 20%, while the overall market averaged only close to 10%. This is a huge difference, and it shows that sticking with the formula paid off significantly over time. Lesson number 4. Keep it simple. One of the most powerful ideas in the little book that beats the market is how Greenblatt keeps things simple. Many investors try to complicate their strategies by analyzing too much information or chasing trends. The magic formula, on the other hand, boils investing down to two key metrics. This simplicity isn't just for beginner investors, it's a crucial reminder for seasoned investors too. It's easy to think that more data equals better results, but that can actually lead to analysis paralysis, the feeling of getting stuck because there's just too much to consider. Instead, Greenblatt's formula gives us a way to make smart investment choices without overcomplicating things. Despite access to vast resources and expert analysts, around 70 to 80% of mutual funds fail to beat the market over the long term. Lesson number 5. Discipline is what completes the puzzle. Discipline is the foundation of Joel Greenblatt's magic formula. While the formula itself is straightforward, it only works if you have the discipline to stick to it consistently, no matter what the market throws at you. One of the biggest challenges for any investor is to hold on to a strategy during tough times or when other hot investment trends start capturing everyone's attention. But Greenblatt emphasizes that without discipline, even the best investment formula will fail. For this, Joel gives an example in the book about Cisco Systems during the late 90s tech boom. At that time, everyone was excited about tech stocks, and Cisco in particular was seen as a must-have investment. Not because of its core financials, but because of sheer hype. Greenblatt explains that a disciplined approach like the magic formula would help investors avoid overpaying for such companies just because they're trendy. A super trending stock will have very low earning yield. This would eliminate it already. By focusing on core fundamentals rather than the market excitement, investors can make more rational and ultimately profitable decisions. To summarize, the stock market doesn't always accurately reflect the true value of companies. The wild mood swings of the Mr. Market must be used to buy good companies at discount prices. The magic formula focuses on just two metrics, earnings yield and return on capital, making it straightforward for anyone to use without overcomplicating decisions. While the magic formula has a proven track record, it's important to remember that it doesn't work all the time. Even during underperforming years, sticking with the strategy has proven to deliver substantial long-term returns. Greenblatt's formula shows that simplicity outperforms complexity. Avoiding unnecessary complexity helps you avoid emotional pitfalls and make sound decisions. Discipline is the foundation of Joel Greenblatt's magic formula. While the formula itself is straightforward, it only works if you have the discipline to stick to it consistently, avoid latest trends and fads, and stick to the process. That's it, guys. If you liked the video, please like, share, and subscribe. I will see you soon with another video about another investing book. Until then, cheers, guys.